Imagine this. You wake up one morning, check your phone, and see a company you use every day just made billions in a single year. People are talking about its stock price going up, and somewhere in the world, someone who bought a small piece of that company years ago just made more money than they earned in a decade. Now, here's the strange part. Most people use companies like this every single day, but they never actually think about owning part of them. They think stocks are complicated, dangerous, reserved for rich people in suits. But stocks are not magic, and they are not a secret language for Wall Street. Disclaimer: this video is for educational purposes only and should not be considered financial advice. Always do your own research or consult a qualified financial professional before making any investment decisions. At the simplest level, a stock is just a tiny piece of a business. And once you understand that one idea, the entire stock market starts to make sense. Let me tell you a short story. A young office worker gets paid every month, saves a little, and keeps thinking, I'll start investing later. Later becomes next year. Next year becomes 5 years. Then one day he looks around and realizes the people who started early are not necessarily smarter. They were just earlier. That is one of the quiet truths of investing. The stock market does not reward the loudest person in the room. It rewards patience, consistency, and understanding. And in this video, I'm going to break stocks down in the simplest way possible so you can actually understand what people are talking about when they say things like shares, returns, dividends, or market crashes. So what is a stock? A stock is ownership. When you buy a stock, you are buying a small slice of a company. Not a full company, not a control panel, just a small piece. Think of a business like a giant pizza. If the pizza is cut into many slices, each slice represents a small part of the whole. A stock is one of those slices. If a company has 1 million shares and you own 10 shares, you own a very tiny fraction of that business. That means if the business grows, your slice can become more valuable. If the business struggles, your slice can become less valuable. This is why stocks matter. You are not just watching a company from outside, you are participating in its future. That is a powerful idea because it changes the way people think about money. Money is no longer just something you spend. It becomes something that can work alongside you. Now, you might ask, why would a company sell pieces of itself? The answer is simple. Companies need money to grow. A business may want to open new stores, build new products, hire more people, expand into new countries, or survive a tough period. One way to raise that money is to sell stock to the public. That is why stock markets exist. They connect businesses that need capital with people who want to invest. This is what makes the whole system so interesting. The company gets money to grow. The investor gets a chance to benefit if the company grows well. It is basically a partnership, even if the relationship is indirect. And that is why people often say investing in stocks means investing in the future of business. Let's make this real. Imagine a small coffee shop opens in your neighborhood. At first, it has one location and only a few customers. But over time, people love it. The owner wants to open 20 more stores. Instead of borrowing all the money from a bank, the owner decides to sell a small part of the business to investors. Now, those investors own a piece of the coffee chain. If the brand becomes more popular and more profitable, the value of their ownership may rise. If the business fails, their investment can fall. That is stocks in everyday language. Ownership plus risk plus the possibility of growth. So what is the stock market? The stock market is just a place where people buy and sell shares. It is not one physical building anymore. It is a network of exchanges and electronic systems where investors trade ownership in public companies. Now here is where beginners get confused. They think the stock market is the same as a company. It is not. The company is the business. The stock market is the marketplace where pieces of that business are traded. That difference matters. If a company is doing well, the stock price may rise. If investors are worried, the stock price may fall. But the price does not always move exactly the way the business moves in the short term. Sometimes fear pushes prices down. Sometimes hype pushes prices up. Sometimes both happen at the same time. That is why stock prices can look emotional, because in many ways, they are. A stock price moves based on supply and demand. If more people want to buy than sell, the price tends to go up. If more people want to sell than buy, the price tends to go down. That sounds simple, but behind that simple rule are human emotions. Hope, fear, greed, panic, excitement. A company may report strong results, but if investors expected even better results, the price can still fall. That confuses beginners all the time. They assume good company means rising stock price. But the market is not only reacting to what is happening now, it is reacting to what people think will happen next. That is why stock investing is part business analysis and part psychology. And once you understand that, a lot of stock market behavior stops looking random. Picture two people at a market stall. One wants to buy an apple for $1. The other wants to sell it for $1.50. No trade happens until they agree. The same idea works in the stock market. Buyers and sellers are constantly negotiating through the market. When more people believe a company's future is bright, they are willing to pay more. When more people become nervous, they rush to sell. That is why stock prices can move sharply even when the business itself has not changed overnight. The market is not only trading facts. It is trading expectations. There are two main ways investors can make money from stocks. The first is capital growth, which means the stock price rises over time. If you buy a stock at $100 and later it becomes $150, your investment has gained value. The second is dividends. Some companies share part of their profits with shareholders by paying them cash regularly. Not every company does this, but many mature businesses do. This means investors can benefit in two ways: price growth and income. That is why stocks attract so much attention. They can potentially help people build long-term wealth in a way that sitting on cash usually does not. But, and this is important, stocks are not a guaranteed money machine. They are investments, which means they involve risk. A lot of beginners hear the word risk and immediately get scared. But risk is not the enemy. Uncontrolled risk is the enemy. Stocks go up and down because markets are uncertain. A company can be excellent and still face a bad year. A stock can drop even if the company is still strong. That does not always mean something is broken. It means the market is constantly adjusting. The key is to understand what kind of risk you are taking. If you buy a stock because everyone on social media is excited, that is a very different decision from buying a stock after understanding the business, the price, and the long-term story. Good investing is not about avoiding all risk. It is about taking the right kind of risk. Now, let's talk about why people still invest in stocks even though prices can be volatile. Because over the long term, stocks have historically been one of the strongest ways to build wealth. The long-term average return of broad market investing has often been cited around 10% a year, nominally, though results vary and yearly returns can be very different. That does not mean every year goes up 10%. Some years are strong, some years are terrible, some years are flat. But over long periods, patience has often mattered more than perfect timing. This is why investors who stay invested through market noise often do better than people who keep jumping in and out. The market rewards time, not drama. One of the biggest mistakes beginners make is trying to get rich quickly. They see a stock rise fast and think, I need to buy now before I miss out. That feeling is powerful. It is also dangerous. Because emotional buying often happens when people are already excited, and emotional selling often happens when people are already scared. Both are bad decision makers. A smarter approach is to slow down and ask a simple question. What business am I actually buying? That one question can save a lot of pain. Another common mistake is buying a stock without understanding the business. Some people know the company name, but not the actual business model. They know the logo, they know the hype, they know the chart, but they do not know how the company earns money. That is like buying a house without checking the roof. A good investor does not need to be a genius, but they should understand what they own. That includes how the company makes money, whether it is growing, and whether the price makes sense. The third mistake is believing every stock is the same. It is not. Some stocks belong to fast-growing companies. Some belong to mature companies that pay dividends. Some are highly volatile. Some are more stable. Some are expensive. Some are cheap for a reason. That is why people often start with simpler ideas like broad index funds instead of trying to pick one perfect stock. A lot of beginners think investing means finding the next giant winner. But many successful investors focus instead on consistency, diversification, and staying in the game. Now let's talk about why people panic when stocks fall. Because when money is involved, emotions become louder. A 10% drop can feel small on paper, but if that 10% is your savings, your hopes, or your future plans, it does not feel small at all. That emotional side is real, and that is why investing should never be done casually. The goal is not to make people fearless. The goal is to make them prepared. A prepared investor expects volatility. A prepared investor does not confuse temporary fear with permanent failure. That mindset can make all the difference. Think of two friends. One buys stocks during a boom because everyone is making money. The other buys slowly over time, keeps learning, and does not panic when the market gets ugly. When the market falls, the first friend freezes. The second friend keeps going because they expected bad days to happen. A few years later, the first friend is still searching for the perfect entry. The second friend has built real ownership in strong businesses. That is the hidden difference. Not intelligence, not luck, just behavior. So what should a beginner look for? Not a secret formula, not a magic shortcut. Start with the basics. A company should ideally have a product or service people actually want. It should make money in a way you can understand. It should have a reason to exist in the future, not just today. And ideally, it should be priced in a way that makes sense compared to what it earns and what it can become. This is why research matters. Not because investing must be complicated, but because your money deserves attention. A stock is not just a ticker symbol. It is a living business with real employees, real competition, and real problems to solve. Here is the easiest way to think about stocks. If the business grows, your investment can grow. If the business struggles, your investment can struggle. If the market becomes more optimistic about that business, the stock price can rise. If the market becomes more pessimistic, the price can fall. That is the whole game at the simplest level. Once you see it this way, stocks stop feeling mysterious. They become a way of owning a tiny part of real economic activity. And that is something ordinary people can understand. This matters because financial freedom often starts with understanding. People do not need to become traders. They do not need to stare at charts all day. They do not need to guess every market move. They need a basic framework that helps them separate noise from reality. And stocks are one of the first major lessons in personal finance because they teach ownership, patience, risk, and long-term thinking all at once. If you can understand stocks clearly, a lot of the finance world becomes easier to follow. There is something powerful about realizing that the stock market is not some closed club. It is simply a system where people buy pieces of businesses and hope those businesses grow. That is it. No mystery, no secret handshake, just ownership, risk, patience, and time. And for many people, that small shift in understanding is the moment money stops feeling like something that only happens to other people. It starts feeling like something they can actually learn. So if stocks once felt confusing, I hope this made them feel simpler. Because at the end of the day, stocks are not about chasing noise. They are about understanding businesses, thinking long-term, and staying disciplined when emotions try to take over. In the next video, we can go one step deeper and cover things like how to choose your first stock, index funds versus individual stocks, or how beginners can start investing safely. For now, remember this one sentence. A stock is a small piece of a business, and time is often the investor's greatest advantage.